We are asking what the fuck is personal investing?
And the cool thing is we are going to invest live.
Women are actively building wealth in their everyday life.
That is such a perfect way to articulate it, is meeting women where they are.
It's a great question. Everybody's talking about it.
70% of women change their wealth advisors when their husbands pass away.
1 in 2 women between mid-50 and mid-60 retire with no qualified retirement savings.
One of my questions was, what's the minimum amount you start with? But that actually is like a misleading question.
Many don't know this.
What do I do? And how should I think about it?
Okay, we're ready.
I got a lifetime of knowledge.
Let me call Mimi.
Welcome to Actual Experts. I'm Caitlin.
And I'm Lundie.
And we don't have all the answers, so we're going to ask the questions.
Today, we are asking what the fuck is personal investing to Cameron Rogers, our actual expert. Very excited to get into it. One of our most requested episodes from the very, very beginning is personal investing. What the fuck is a mutual fund? What the fuck is an index fund? What the fuck is an ETF? Nobody knows. And we're going to find out.
Nobody knows. And the cool thing with this episode is we are going to invest live. So our disclaimer, which will already be in this, but our disclaimer is none of this is actual investment advice.
What do they say is for what purposes only?
Educational purposes only. And what is cool is we're actually going to do 2 parts with Cameron. So this one will be you're starting out investing, you're not sure where to start or how to start, your baseline education. We're going to invest $5,000. We're going to do a part 2 with her because we did get requests on what do you do when you want to go beyond just investing in ETF. So now you've done your initial investing, you have maybe a bonus that you're looking to invest or inheritance, whatever it is, a sum of money that you want to do something a bit more with. We will do that in part 2, and I will also invest live in that one.
Exciting.
This is also an interesting episode for us because the facts that came out of the research for this are so similar to the precipice for this podcast. And for wanting more information, this was definitely one of the conversations that kind of triggered it all with our girlfriends. And the biggest thing doing some of the research on this, which we've said many a times, is how crazy this wealth transfer is that's coming up. And that over the next decade, women are expected to control $30 to $34 trillion in assets in North America alone. That does not count the UK, South Africa, wherever other people are in the world listening. It's literally just North America, which is crazy. Wow. So that means that women will hold more financial power than ever before, but only if they're prepared to manage and grow it. And I think that is a super key thing, is that you can have money in your bank account, but unless you're growing it and managing it properly, you're not really harnessing the power that it can give you. So it's very exciting.
Totally, 100%. Before we get into some actual stats, should we fill in where we are at with our personal investments? Just
sure. Yeah, let's do it.
Baseline knowledge.
Yes. Okay, tell us, Lundie. Do you invest?
I do invest. I have a brokerage account out of the US that I do pay a financial advisor to effectively manage for me. That is controversial. A lot of people say you should never do that because it's giving away your money. Maybe we can get into that with Cameron. But I basically had a little bit of money saved up. I had put away a certain amount of money, $40,000 to $50,000. And I was like, okay, I think it's time to put this somewhere else so that it's not sitting in my savings account, which it's making no money, 1% interest or even less than that. So I actually reached out to a friend of ours' brother, who is a financial advisor out of New York. And I got on the phone with him and said, I don't know what a mutual fund is. I literally don't know what any of this means, but I was told that I should do something about this. And so he stuck a lot of that money into accounts based on my risk profile. I basically said, I might want this in the next 5 to 10 years if I want to buy a house. Otherwise, maybe, I don't know, at a later stage kind of thing, like a long-term time horizon. Mm-hmm. So he designed a portfolio based on that, and it's been doing pretty well. So as they say, set it and forget it. I basically pretend like that money is not there. I don't touch it. And I wouldn't have done it if I didn't have a financial advisor. I will say, like, a lot of people yell at me and are like, you're giving your money away by doing that. And there's plenty of just online apps and robo-advisors you can go do it yourself. But my mentality with that was like, if I'm not going to do it myself and I have to pay this guy 1% of my total assets under management, which I think at one point was like $50 a year. I was like, you may
There
have
you
that. I'm like,
go.
I'm not one of your high net worth clients. You're not going to make much off of me, but just at least to get me
$50
going.
for you. That will cover 3 coffees in New York.
Yeah, exactly. If that, exactly. So a lot of people say as your wealth grows, which obviously is the goal, you're
Yeah.
giving more and more of your total amount away by having someone else help you with it. But I was like, you know what? That's the only one I'm going to do at this stage. So
Yeah.
that's how I got started. What about you, Caitlin?
Yes. Okay. So I'm trying to think when I actually started investing. Probably 10 years ago now. I don't use a wealth advisor. I use an app called Wealthsimple, who honestly at this point should sponsor us because I speak about it on every single episode. But they're a robo advisor. So they ask you a bunch of questions in advance, try to understand your risk profile. To your point, how long do you want to keep it in there? And then they invest it for you. I don't know what their fee structure is, but I think it might be no fees, but I could just be saying that. So I will Google it. And we
And
will
a
talk
robo
about it in-
advisor means there's
Oh,
no.
yeah. A robo advisor is basically an automated investing service. Instead of hiring a traditional finance advisor, which is what Lundie did, who picks investments for you, you sign up on an app or website, answer some questions like your age, goals, and the platform uses algorithms to build and manage a portfolio for you. So low cost robo advisors usually charge way less than human advisors, often 0.25% to 0.5% of assets per year versus the 1% plus that human advisors charge. They typically invest your money in ETFs, exchange traded funds, which we will learn more about later, and spread across stocks, bonds, and sometimes alternatives. It's very hands-off. Examples are Wealthsimple, which is what I use in Canada, Betterment, Wealthfront, and Vanguard Digital Advisor are examples in the US. It has been fantastic for me. I have tried to play the market, as they say, where I cherry pick stocks and companies that I think are going to do well. And I can confirm that is a terrible idea. I have lost almost all my money in that. It has gone down. One of my
will be like to be like, I heard at this dinner that I was at that everyone is buying copper. I don't know why, but I just went and invested in a copper mine in Argentina. I'm like, okay.
Yes, and
Let me know how that goes for you.
yeah, literally. And then that's so funny. One time I was like, okay, all electric batteries need lithium to move and power themselves. So I am going to invest in a lithium mine. But then I don't know why I was like, but it must be the most ethical lithium mine out there. So then I spent all this time researching lithium mines and their like impact on the environment, and then found a super progressive one that was putting all these measures in place to like do the best for the environment. I was like, perfect, I'll invest in this one. Obviously,
Did it like go under?
no, I don't even know. Maybe they ran out of lithium. It's just gone to zero. It's terrible.
Yeah.
So I will say whenever I do those crazy things, I'm only ever putting in money that I'm willing to lose. So it's
You
like
have to. Yeah.
$100 here, like $300 there that I'm putting in. And it's kind of just a bit, I guess, maybe it's like a version of gambling. It
It's
essentially
like
is
an
gambling.
educated guess, and most of the time, it's probably not going to make you the big bucks.
Yes.
But sometimes it does.
Yes,
And so,
exactly.
It's worth
Yeah.
a shot sometimes.
Yeah,
But
it's hilarious. Okay.
okay,
So
should we get into some actual
actual
statistics?
facts. So we spoke about the wealth transfer, the 30 to 34 trillion. Interestingly, I think when we did our intro episode, we said $30 trillion. And in the latest numbers, it's looking like $34 trillion. An extra 4 trillion is a shit ton of money. So that will be in the
It's going
hands
up and
of
up.
women. Yes.
Yes.
Ladies, it's time to stand up. Okay. So the next one, a little bit scary, is the retirement gap. So on average, women retire with 30 to 40% less wealth than men, yet they live 5 to 7 years longer. So this means without investing, many women risk literally outliving their money, which is really crazy. So that's something to keep in mind. I think sounds scary, but there's never too late to start investing and growing your wealth. So something to keep in mind. We all don't want to be 80 and not have any money in the bank.
No, so stressful. What do they say?
Yeah.
The best day to start investing was yesterday. The second best is today.
Correct. There you go.
You can
Yes.
quote me on that one, guys.
You could quote Lundie
Lundie's
on that
mom.
one. So next one, we've heard this from a lot of our guests already, but when women do invest, research shows they often outperform men. This is because they trade less frequently and take a long-term approach. The small difference compounds into a huge advantage over time. So it says that they outperform men by 0.4 to 1% per year, which doesn't sound like that much, but with compounding interest, it can be a lot. Okay, that's a term we always hear, but it feels like no one has explained. Compound interest. Compound interest means earning interest on both the money you put in and the interest that the money has already earned. Here's the example. You earn interest the first year. The next year, you earn interest on the original money plus the interest from the first year. Over time, this creates a snowball effect. Your money grows faster and faster. Example. If you invest $1,000 at 5% interest, after 1 year, you have $1,050. The next year, you earn 5% on that $1,050, not just the original $1,000. So you end up with $1,102.50. That's the power of compounding. Your money starts making money for you. And it ties into what we heard with Elaine on blockchain, where she was saying that women actually, because they do better, they stick to their guns, they know what they're doing, they don't get freaked out by the market, they hold on, keep going. So we love that for the ladies. Keep it going. There is one there too, though, that only 26% of women say they feel confident investing compared to nearly half of men. But the kicker is that when women do invest, again, their results are often stronger. So less confidence for no reason.
Everyone who's listening to this can invest. It is
Can
possible.
invest. I know sometimes I listen to some men in my life. I will say it's not Steven. I will not let him down on that one. He actually is very good at investing because he is so safe. Other men I know in my life, the amount of money they've lost on bad investment decisions because they think, oh, I am so smart. I can see that this one company is going to blow the rest out of the water, and then it doesn't. And they haven't diversified. And that is the crazy thing, is they put all their eggs in one basket and they think this is the winner, the one that's going to go to $1 billion, and it doesn't. So,
and that's the power of the exchange traded funds. Thank you. Exchange traded funds is that they're little baskets of different stocks that have been picked for you based on all your interests and your risk profiles, and then it's delivered to you so that you don't have to put eggs in different baskets. You get them
exactly.
Yes. Well, they are all in one basket.
They're all in one basket, but it's a diversified basket, lots of different eggs, not all of the same color.
Yes, correct. There you
go. Okay. Last one. We have heard from a few of our friends who've said that they don't know how to invest or they don't know where to start investing. And so all their money is currently sitting in their savings account. So if you keep your money in cash, inflation eats away at it every single year. At a 3% inflation rate, $10,000 sitting in savings loses nearly half its value in 25 years. Not investing is actually riskier than investing.
Isn't that crazy?
So that is crazy. We are going to do an episode on what the fuck is inflation coming soon, but inflation is essentially the cost of living going up. And if the cost of living is going up 3% every single year, but your savings account is only earning you 1.5% interest, it means you're actually losing money because it's more expensive out there than what you're earning. It's actually riskier to keep your money in cash. You need to put it into investing. So we will learn
your emergency account, like you keep several months of emergency cash, and then once you have a surplus that you're ready to invest, then it's worth investing. But you should have a little savings.
Should have a little bit, but I think that savings can be in investing because you just sell it if you need the cash.
No, because if you lose it all, and that's like your life savings and investments, they say you should keep savings in
cash.
They say a high yield savings account, but you should have at least like 3 to 6 months worth of savings in the bank. Are you like, all of my money is in?
This is a question for Cameron. We can ask. Do you keep money in cash? Okay, so speaking of Cameron, who is she? Cameron Rogers was recommended to us by multiple women, which is fantastic. One of them being Anna Whiteman, who did our What the Fuck is VC episode. So Cameron is based in New York. She is a CFA and is a partner at Angels Wealth Management in New York, where she helps individuals and families make sense of everything private equity stakes to generational wealth transitions. With over 15 years of experience at firms like JP Morgan and Ellevest, she's seen firsthand how money shapes opportunities and how confusing it can feel. Cameron is passionate about helping women feel more confident and connected when it comes to their finances, which we love.
Amazing. Let's bring her on.
Woohoo.
Please note that this pod is for educational purposes only. Nothing we say should be taken as financial, legal, or medical advice. Please do your own research, and when in doubt, ask an actual expert.
Now, You look more like a real podcaster than we do with the headphones.
100%.
Like, Jeff Bezos, send me some cheap headsets. So, yeah. And
I will
Lundie,
take
it's nice to meet you in person.
You too, I know, after all of our emailing. Thank you so much for being here. Caitlin was ecstatic after she spoke to you on the phone. She was like, this is going to be amazing. So I'm
Oh,
very, very
good.
excited.
I
Yeah.
loved it. We were both in our casual Friday
Yes.
streaming mode.
Yes. Actually had our episode with Elaine yesterday on what is blockchain, which was with Elaine Asher.
Perfect.
Yeah.
Oh, good.
And she told us to say hello. She was
Okay,
like, you have to tell her.
yes. I will text her as well.
Very quickly, the way we run every single podcast is that one of us is the researcher and does all the questions, chats, and then one of us comes in what we call blind. And that means that they take the position of the listener.
Yeah, I love it. Thank you.
Okay, let's dive in because I feel like we've got a lot to get through. But first, we wanted to get to know you a little bit more. So, Cam, you moved from institutional investing to individual investing. And can you just tell us why you decided to make that change? And then just very briefly, what is institutional investing and what is individual investing? Because we
Totally
need that clarification.
Yeah. So I started my career at JP Morgan during the global financial crisis, kind of on the tail end, so 2009. And as you mentioned, I was in the bank's institutional investment management group. What that group did was manage the money of large pension funds. So think of these as retirement schemes in the US. I know you both are global, but I'm going to focus on the US right now. So we were managing their money so that they could then provide their retirees retirement payments, pension payments. Their retirees were teachers, firefighters, long-serving employees. So what was fun for me starting out in this space is it was deeply meaningful work. And I did it for almost 10 years. The caveat there, as you might imagine, is that new institutions of that kind aren't being created every day. And so what happens when you're a young person in that space, that there's like a supply demand imbalance of opportunities. So I saw that about 10 years in. I appreciated the experience, but I also saw this was now in the mid 2010s that there were new wealth creation opportunities happening every day. More wealth was being created. And so that's when I said, you know what, I'm going to make this pivot from working with institutions to working with people. And I'm grateful for that experience, but I really want to go where the money and opportunity is.
And then within individual investing, that is around wealth management. So what does that mean, wealth management?
Yeah. I think if you asked 100 people on the street what wealth management is, I think 99 would say wealth management is about managing money, which is not wrong, right? Yes, wealth management is about managing money, but it's also about managing these life decisions and trade-offs, and in many ways, priorities. Money touches so many areas of our life, and as the investment space in general becomes more commoditized, I'm like, how can I continue to add value? So I do feel like I have this network of phone a friend, and part of my role for people, friends, as well as clients is connecting the dots where it makes sense.
Totally. Okay. So on that, we are here, we're talking about friends, come in all shapes and sizes, but we are talking about women today specifically and women investing. And so one of the things that Lundie and I have spoken about, Cam, is this $30 trillion wealth transfer that's happening with women, and how over the next decade, a ton of money is transferring into women's hands. Baby boomers are dying. They're transferring their wealth to their wives because they live longer, to their children, but a big transfer is happening to women. I was at a conference in May, and there was a bunch of women on stage talking about this, and they were saying the industry needs to change. And it was a super interesting conversation. But I want to understand from your perspective what you're seeing changing in the industry because of this big money transfer that's happening.
It's a great question. Everyone's talking about it. And before we talk about the transfer piece, it's important to acknowledge that women are actively building wealth in their everyday lives. So through their businesses, through their careers, through home ownership, investing, like so many women are increasingly the primary decision makers in their family household lives. What we're describing with the great wealth transfer is effectively passive in nature, right? Like if money is coming to you, it's passive in nature. So I want to make that distinction because I think what conversations around the great wealth transfer misses is sort of all of this wealth being built by women actively, and it really focuses on the passive side of
That's a
the
great
equation.
point.
With that said, the numbers, the quoted numbers are astounding. If you look out further, it's over $100 trillion coming to women in the next 20 years or so. If you bring it closer today, as you noted, by 2030, and this is a US statistic, 40% of US wealth is projected to be in the hands of women. That equates to around $30 trillion, and that's around our GDP in the US, which is gross domestic output of the economy. If you combined women in the US and Europe around that time, so 2030, that number is closer to $60 trillion. And those transfers are happening in a couple of different ways. So there's the sort of vertical transfer, and that's from parents, family members, that's generational in nature. And then there can be a horizontal wealth transfer, which is peer to peer. And the horizontal wealth transfer is basically an actuarial reality for women married to men of a similar age. And that's because women live on average sort of 5+ years longer than our male counterparts. But with that horizontal piece, what ends up happening for women who aren't actively engaged in the household financial conversation is you're really sort of stepping into this position later in life. I think what the conversation is also missing is what wealth actually is. You know, if you follow the lives of some of the richest individuals, richest families, you'd be surprised to know that a lot are cash poor. And that's because where wealth is created is through land, real estate, private businesses. This is not money sitting in cash necessarily, unless you're like a hedge fund manager and kicking off cash every year. So to your point, from a structural perspective, the industry really needs to evolve to serve those conversations where women are negotiating on behalf of these assets and transactions and things. And where things stand today, you know, 7 in 10 financial advisors are men in the US, 7 in 10 law firm partners in the US are men. And so we need more women, and especially senior women, in these conversations to really kind of help them move along.
Yeah, and guide them. 70% of women do change their wealth advisors when their husbands pass away. So that in itself is interesting. Are you surprised by how there may be a bit of a lack of wealth management businesses popping up that are specifically targeting women? It seems like that is an amazing opportunity.
Yeah. You know, I think historically for women has too often meant like beautiful and expensive. Like you pick up your husband's razor, boyfriend's razor, and it's basically the same razor you have, but yours costs 10 to 20% more, and it's maybe curved nicely and pink. So I think that's
pink. I was gonna
I mean,
say.
that's pink. I had this experience a couple weeks ago. I was like, wait a second. And so that's the fear, and where I think there's a lot of skepticism. I can't speak for the entirety of the industry. I will speak for my practice serving women. For me, there are distinctive elements of the approach that I would say are different from, you know, what I've learned through all of my training. I think first and foremost, it's meeting women where they're at, whether that's physically or emotionally. So that could be gathering in spaces that feel comfortable. So these conversations are more authentic. Like I've had these conversations over, you know, getting nails done or after a dance class. Like that's just not yet super embraced by the industry. I think the other really important part is distilling financial information down to their mechanics and pairing them with tangible examples. Again, that isn't necessarily dumbing things down, but if you think about how much women touch in their everyday lives through their
Totally.
work, through their 6+ hours of unpaid care on average, through controlling 80% of consumer decisions. Like we touch so much, so we need those tangible examples. To your point around this podcast, I also feel like an extended money network is super valuable, to my point from earlier. So saying, okay, on this front, we're going to call Laura, and over here, we're going to call
Right.
Jane, and kind of create this infrastructure around clients. And then last, ways where money can do double duty, whether that's on the charitable side, whether that's on the investment side, whether you combine the two. That's really important. And so I understand the hesitation of like, let's make something, beautiful and more expensive. But those are the ways I think one can really differentiate their business.
We had this conversation early on when we were starting this podcast with both men and women who rightfully so said, I don't feel like you're giving women enough credit. Women are smart. And so it sounds like you're dumbing this down for them. Women are perfectly capable of understanding how investing works. And we were like, that's the point. I could understand where with the pink washing, for example, of some brands that make everything pink and everything pretty because it's geared towards women. That maybe can be controversial, yes, because some women find that offensive, or that could just be because that's the branding that gets the attention of more women. Who knows? But the purpose of this, to your point, is not to dumb anything down. It's just that there's enough that people don't know. If you don't know, you don't know. And so to have a space, a safe space, wherever that is, after dance class or this podcast or around dinner tables with friends, where you can just ask the questions, because why am I supposed to know how an index fund works? No one ever taught me,
Yeah, Lundie, I totally agree. And I think that there's a lot to learn, or I think there's some things to learn from our male counterparts. And it's not so different. For me, that was very visible in the place and space I was at a few weeks ago. I was up in Boston at an angel investing forum, and it was like the gathering was electric. It was all women, angel investors. No one was talking around one another. Like people were writing checks, getting things done, trading perspectives. But like as we were talking, we identified a few things that we see in our male counterparts that maybe we should think about for us as women. And those things were faster implementation. So like moving from idea or desire to check with less analysis paralysis. I feel like we kind of like inherently get analysis paralysis. The second piece we talked about was sector diversification. Like it's so easy to gravitate to something but you want to make sure your portfolio, your investing, your life has diversification to a lot of different areas. And if it's an area you really don't know, then you need to find that expertise. And then the last piece, which is so powerful, is the socialization of wins, right? Like how often does a guy say, oh, this is my friend Joe. We went to university together and we also invested in Rob's company. Like how often do you see women say that? Like not enough, right? So rarely. Like you kind of get fearful. So I think there are things to learn from the guys, but I don't think that things are so far off as some would articulate.
I agree. I think the purpose of a lot of this is just so that women can join the party or come to the table. It doesn't have to be two separate tables. The goal is just that we learn enough of the jargon and the previous gatekeeping of the industry so that we can do it ourselves, So I'm with you there, totally.
Yeah. No, and I think what your answer was around meeting women where they are. At this conference, people kept asking, how does the wealth management industry need to change to better service women? And no one really could articulate it. And that is such a perfect way to articulate it, is meeting women where they are. And it actually, to your point of male counterparts, isn't different than how we've been servicing men. We meet men where they are. We go to the golf course. We go to the squash courts. We do these different things. We meet them where they are. So just doing the same for women seems so obvious, but it's only just starting to happen now. So I think that's really exciting, and I'm so happy to hear that from you. But I think that is a perfect segue to getting into the actual investing and meeting women where they are, which for a lot of our friends is ground zero. How do we start with investing? So, Cam, you and I spoke about this earlier, and I wanted to chat to you about it, about a bit of like what's going on. Women get to retirement age and they maybe don't have enough money.
In the US, so again, this is a very US perspective.
Yeah.
1 in 2 women between the ages of mid-50s and mid-60s retire with no qualified retirement savings. That's
Wow.
1 in 2. To caveat this number, the numbers for men aren't that much better. So they're just not great overall. What I think is harder for women is that for women who have saved, what they have is typically savings that are 30 to 40% less than their male counterparts. And that's despite living, on average 5 years longer than their male counterparts. So that's like a very cruel financial mismatch for so many individuals in the US. I think homes and home ownership is thought of this nest egg, like separate from long-term qualified retirement savings. But even, in the last few years with what we've seen from a natural disaster perspective, assuming your home is your nest egg is dicey given what we're seeing across the country.
Yeah. It's scary. And I think at the age of early 30s, mid 30s, late 30s, early 20s, where that seems so far away. And you're like, oh, I have enough time. I'll figure it out. I'm going to save. I'm going to earn more in my next job. I'm going to do it. But it does give you a little bit of a wake up call that you kind of need to start now. One question we did have for you is, and a few of our friends said this, is that they keep all of their earned money in their savings account and they don't invest it. We wanted to know from you why that is a bad idea and why they should be investing it. And then we have a follow-on question to that.
So money in a savings account is not necessarily a bad idea. I'm not discouraging that. And we can talk about what strategic savings look like and emergency fund savings look like. What tends to be tough for women is that we on average keep 70% of our wealth in cash, which I think is too high a number. And to kind of like put some math around this, over the last 2 decades, 20 years or so, if you look at, and again, I'm going to focus on the US for simplicity, but if you look at the US stock market, the US stock market has averaged 7 to 10% a year or so. If you look at the US bond market, that has averaged 2 to 4% in returns every year.
In terms of returns, what is a return? What is a bond? What does it mean to make 7 to 10% or 2 to 4% on what money? What does that mean again?
Yeah, so it's on money invested. So say you have $100,000 and you're invested in the stock market. And in that year, kind of those investments returned 7%. At the end of the year, your total portfolio would likely be around $107,000. So that's how we think in terms of return. In terms of the difference between stocks and bonds, when you purchase a stock or you purchase a portfolio of stocks, stocks are effectively a share of a company. And when we talk about it, I'm going to talk about public companies, but you could have interest in a private company as well. So what do you want when you earn a share of a public company? Well, you may like that company. You may be a consumer of that company and want to support them. You could also say, look, I'm a consumer of them. I think they're doing well. I think they're going to continue to grow. And therefore, this value of the company may go up. And I want to participate in the growing value of that company. So when you're investing in stocks, it's usually for that appreciation component, like the appreciation of what you're invested in. Think of a bond, and when you're investing in a bond, as you basically lending money. And if you're buying a government bond, that's effectively you lending money to a government. If you're buying a corporate bond, that's you lending money to a corporation. So you're saying, I'm going to give you money for a period of time. I have to receive some compensation for that, which is periodic interest payments coming back to me. So cash coming back to me for lending you money. And then, oh, by the way, after a certain period of time, which is the duration of the bond, I want my money back. So if you think about it, when we kind of juxtapose stocks and bonds, stocks, you're owning a share of a company. That company's value can move around over time. Bond is effectively the borrower's promise to pay you interest and your principal back. So it tends to be more capped in nature in terms of return and more cash flow oriented, because the majority of the return that you're getting from it are those interest payments coming back to you.
Makes total sense. Thanks for clarifying.
Okay, terrific.
I cut you off then kind of mid
Oh,
thought
yes,
there.
yes. So we talked about stocks, we talked about bonds. If you look at like savings account earnings in the US over the last 20 years or so, it's been 1 to 2%. So if you took that example of investing $100,000 20 years ago, and that's investing 20 years ago and not adding any money or doing anything else, for that kind of stock only portfolio, compounding 7 to 10% every year for 20 years, that $100,000 is now $500,000. For that $100,000 bond portfolio, compounding every year at 2 to 4%, that $100,000 is probably $180,000. For that savings account, the $100,000 is likely now $135,000. So, when we're talking about why invest versus keep money in cash, you can see over time that compounding effect is pretty pronounced.
And on that, so keeping money in cash, Lundie and I spoke about this earlier too. We had different opinions on what we thought. We're told to keep an emergency fund. Do you keep the emergency fund, say that's 3 or 4 months of your paycheck or maybe 12 months of your paycheck? Do you keep that in cash, or is that an emergency fund that you would maybe invest in? If you need it, you sell your stocks and then you turn it back into cash? What would that look like?
I would not invest it. I would keep it in a checking account, a savings account, or something very short term and very liquid. So that could also be a high yield savings account, investing in, again, US perspective, short term treasury bonds, so like maturing in 3 months or so, or a money market fund.
So that's essentially if your car breaks down or someone gets sick or you need to buy a plane ticket or your house floods or whatever, you need that money supposedly instantaneously. And so trying to get those out of markets would be cumbersome and lengthy in time, right?
Sure. Well, a couple of things there. I mean, it's October 1st, and I know this will come out later. It's in the US, the first day of our government shutdown, and we don't know how long it'll be. The issue with investing that money over a very short period of time is you just have no sense of what the stock markets will be doing in that case of you needing that money. And what does not feel good is, let's say, you're in a stock market downturn, so that money is worth less. You need to dip into it. You're frustrated because you feel like your money is not working for you. And then honestly, you probably hold that with you for a long time. And when it's time to invest again, you're like, I don't want to do that because this did not work out for me before. And we really want to create things like sustainable systems around money. And as part of that, that's bucketing things out so you don't have these cash strapped scenarios where you're like, I never want to do that again.
So what would you do if, say, you don't earn that much? You're earning minimum wage or just above minimum wage. You are thinking, okay, my emergency fund is 3 months of rent and a little bit extra in case something goes wrong. But that amount of money is actually the only savings that you do have. Do you keep it as your emergency fund in cash, or do you take the risk potentially and maybe put half of that into an investment and have less emergency fund and cash?
I would keep it in your emergency fund, to be honest. Obviously, goal is 3 to 6 months of living expenses, but like we're all doing what we can, right? So it's really what you can do. After that, before investing, I would actually put minimum debt payments in there. So you obviously want to cover those so you don't incur any penalties, so that there's not an impact on your credit rating. Following that, I would actually advise, to the extent that someone has an employee match as part of a 401k, 403b, at least try to get to that point from a tax advantage money perspective. 'Cause if you can get up to that kind of max employee match, that's effectively free money to you. And then I would start tackling like higher interest debt, the debt that has an interest rate that is arguably higher than what you can return in the markets. As I mentioned before, wealth management, everything is a trade-off. So I would tackle that higher interest debt.
So
And
this is all before you
all
start
before.
investing.
Yeah,
So
all
your
before. Yeah.
emergency fund, credit card loans, student loans, looking at that
Retirement
first.
Kind of. So
Okay.
emergency fund, minimum debt payments, not necessarily the full balance, but at least like making sure you're good on those payments. Then retirement contributions to the extent that you can get an employee match. Then really trying to pair high interest debt. Because if you think about high interest debt, if your annual interest rate is in the double digit percentage range, which we know a lot of credit card debt is, you really can't earn through your investments that consistently every year. Like your debt is going to be more expensive
Than what
than
you're
you're
earning.
investing. So you want to tackle that. And then when you get into this like lower interest debt, and a lot of that can be student debt. So I would say kind of like sub 7%. And then I would begin investing and sort of splitting off your investing with some of the pay down of your lower interest debt. And again, that goes to this idea of if you're in a diversified portfolio that's compounding year over year, you may actually have a positive spread between what you're earning on the portfolio versus what the debt is costing you every year in interest.
Okay, so putting numbers to it, when you say high interest debt, that on say your credit card, you have big debt on your credit card. High interest debt is like 10, 11% potentially that you're paying on your credit card debt, but then low interest might be your student loan, and I don't know what student loan rates are, but maybe that's 3% you're paying on your student loan. The high interest side on your credit card, because it's 10 or 11%, but maybe on your investments you're only making 7, you're still losing money. So that's why you pay it off first, because it's more expensive than what you're earning. But if you're making that 7 and you're paying off your student loan, which is at 3%, even if you pay that minimum, you're still making that 4% spread in between. Is that correct?
Yeah.
Okay.
You got it.
Lundie, does that make sense?
Yeah, I'm following, but I think there's just nitty gritty around even, I think, the nuts and bolts of all of this. But this is
Yeah.
helpful in terms of, I think a lot of people are like, I'm not investing yet.
Totally.
Am I doing something wrong? And this is helpful in understanding that actually there's quite a few steps ahead of prioritizing personal investments getting into the stock market.
Totally. And I think that because one of my questions was, what's the minimum amount you start with? But that actually is, I think, a misleading question, because there's a lot you need to think about before.
It's personal.
It's so personal. And everyone always says, like, there's no minimum, start with anything. But you do need to think about these things, which I didn't know going into this, thinking about that before you start putting in money.
Yeah,
So
I
that's super
think
helpful.
to that point, everyone says you can invest $1, and I think in some brokerage account, do-it-yourself approach, that's very true. I think it's a little bit. I think that phrase, "you can get started with $1," is a little bit misleading for like membership investment platforms where you may be assessed a monthly fee. And so I would say like a rule of thumb for those listening is that if that kind of annual flat monthly fee eats up more than 1% of your account value every year, you're probably paying too much. And so it may make sense to do kind of a very DIY approach until you get up to that kind of value, which is probably in the thousands of dollars, where it really may make sense to use a robo-advisor or a digital investment advisor. And then the benefits can very much be worth it. But I do think this idea of like invest $1 is misleading when you have flat monthly costs associated with that account.
Can you tell us a little bit more about the pros and cons? It seems like most namely it's this 1% fee or plus percent fee of a robo advisor, something you do yourself on your own, on the internet, on your phone, or a human advisor. I don't know what I would call it. A wealth advisor, a human wealth advisor.
Yeah, I mean, it's really about what you're solving for, and there's no right or wrong. I see everything in terms of opportunity cost. So if you're someone who likes managing your money and have the time to manage your money, or can really focus on it, I think the DIY approach is great. A robo advisor platform is a nice middle ground because you basically had a company do investment due diligence for you, helping you understand the mix of your investments and how much should be in stocks and how much should be in bonds. And oh, you should do this if you kind of want to add an impact layer to your portfolio. They also help with rebalancing the portfolio. And what rebalancing means is, markets aren't static. And so if you have kind of like a target weighting that you want to be invested in, and markets sort of go haywire in any direction, you want someone helping kind of like getting back on course. And there are some other benefits. So that's where a robo advisor can make sense. And then I think where it makes sense to work with an individual is like when you're working through something in particular, when you may not be able to manage your own money or have it passively managed. Like I work with a lot of clients who like simply cannot manage their own money because they're very senior executives or in the legal space, and they're like totally prevented from doing it. There's no right or wrong, and someone may gravitate to one approach at different points in life, and that's as it should be.
Okay, this has been very useful. I want us to get into the actuals part. So we spoke about earlier, Cam, that I want to invest $5,000 with you live. But one thing I wanted to ask before we start doing that is, okay, if we take it from the perspective of what we just said, we have our emergency fund is covered. We've got that in our bank account. So this is my role play right now. I've got my emergency fund in my bank account ready to go 3 to 6 months. I've paid off my very high interest credit card loan, and I'm making my monthly payments to my student loan. The next step is investing, as I've got $5,000 now ready to go that I want to invest with. Where do I start in thinking about this? Because it's very scary going out there. I've got my Wealthsimple app open with me right now, so I'm ready for the advice on what I should do.
And this is not advice to our listeners. We've disclaimed it.
Yes,
This is for entertainment purposes only.
This is for entertainment purposes.
Yes.
This is not investment advice. Everyone's situation is different. So, Caitlin, a couple of things you didn't identify to me is time frame around this money and purpose for this money.
Okay. Time frame around this money. I am happy to let this sit there for the next 25 years. On my horizon, I don't think I'm going to be buying a house in the next kind of 5 years or so. I'm moving around, but I want this to be kind of my nest egg that goes forever.
Perfect. Okay. What I would recommend is a diversified portfolio of stocks and bonds. So the thought process here is this is your first $5,000 of taxable money invested. Like before we would go off in all these different directions, you've got to build your base. Yeah. And your base is going to be kind of straightforward. It's a core. It may not be sexy, but you have to do it. And it, creates higher sort of probabilities of staying invested and continuing with investing. So for you, this is long-term money. You may not need to touch it, but it is also your first time investing. So we want to have an appropriate balance of things that are meant to grow over time, but could be volatile, and things that are stable. I would say that portfolio should be roughly 70% in stocks. Those are also known as equities, and 30% in bonds.
Okay.
If we were to look at a pie of stocks, so we say 70% stocks, 30% bonds, but we're just going to look at the pie of stocks, and that pie is 100%. I would recommend about 60% of that being U.S. stocks. So you want kind of this broad exposure to the whole market. And then where we are today, with really the role of technology and big companies and, their acquisition of other companies, I would sort of have a tilt to some of these larger cap growth companies. So, for that 60%, and I'm going to give you sort of some ETFs to use. Again,
Okay,
this is
great.
not investment advice. These are low cost ETFs. I have no relationship with.
An ETF, that's an exchange traded fund. It's a simple way to invest in lots of different things, like many companies or bonds all at once. Here's how it works. One purchase equals many investments. When you buy one share of an ETF, you're buying a small piece of every company or asset inside it. It spreads out risk. Because you own many things, you are less affected if one company does badly. For example, if you buy the Vanguard S&P 500 ETF, you instantly own a small part of 500 of the biggest US companies. Okay, back to Cam.
With these ETFs, I would say VTI, sort of Vanguard's total US market for that sort of broad US base. And then if you wanted to kind of add that large cap growth piece, BUG, which is another ETF for US.
I not Googled, sorry. In my app, I have the option to on mine it says discover. It's a search bar and it's discover. So I type in VTI, which is okay. So VTI, and then there's 3 options that come up on mine. The first one is the Valdor Technology International Inc. That is probably not right because it's on a different
like,
stock exchange.
not that one.
Definitely not. It says CSE next to it, not the right stock exchange. So then the other one is a VTI Vanguard Group Inc. Vanguard Total Stock Market ETF, and I assume that's the right one.
Correct.
So purchasing this one is 60% of
your 5,000, I would buy 1,400.
Okay, I'm gonna write it down. 1,400, perfect. Okay. So then I've done that.
Now look up VUG.
VUG. Okay, this one easier. There's only one option. Vanguard Index Fund Growth ETF.
I would buy $700.
Okay, VUG.
And
amazing. Diversification. Okay, so I bought $140 of VTI. I bought $700 of VUG.
VTI should be 1,400.
1,400. Oopsies. Okay, I will place another order. Okay, perfect. So 1,400, then 700, and then what next? Are these? They are lower risk investment because it's diversified.
They are diversified in terms of the amount of companies that you're investing in. So you're not like concentrated in a very small subset of companies, but investing in stocks in general tends to be thought of more growth oriented and more volatile because there are so many things that impact the daily movements of stocks. Like for a company, there could be like very specific company risk that happens. Just think of company reporting poor earnings, or maybe their CEO is stepping down. So they're kind of just like inherent risk to companies on a day-to-day basis. And then as you see, if from a macroeconomic perspective, people are feeling like icky about how things are going, you may see people broadly sell stocks. We call that a stock sell-off. And it's not necessarily because anything happened with that company, but people are just generally not feeling great. And so if you're selling out of a diversified ETF, you're inherently, selling out of that pool of stocks.
Got it. An example of that too was when COVID kicked off, the week of COVID, there was a big stock sell-off because no one knew what was going to happen in the markets. And so people decided they wanted more money in cash. So they sold a lot, is my understanding.
Yeah, it was that combination. And then like a true fear that if the world stops, if people are at home, like commerce stops, right?
Yes,
like
totally.
It was a fear people aren't going to work, people aren't buying things, people aren't doing deals. Like the crazy thing that happened is that then there were all of these like random pockets of commerce. Like you remember the Peloton boom and the Zoom boom. So there were these pockets of commerce. But with COVID, it was an economic shock and a market shock. And those are two different things. It was an economic shock, and that economic activity was assumed to like completely stop. And alongside that, it was a market shock. But, one thing to keep in mind is when we talk about the economy and when we talk about financial markets, and usually we're talking about stock markets when we talk about financial markets, those are actually two distinct things. Like the stock market is not necessarily the economy.
Yeah.
It's a little piece of it.
Yes.
Super interesting.
Yeah.
Okay.
Yeah.
So I'm VTI.
Okay,
14.
our U.S. stocks, and
Yeah.
we don't want home country bias, so we do
Yeah.
want to be exposed to companies outside of the U.S. So for kind of an investment in companies, the share or the equity of companies outside of the U.S. in developed economies, I would look up a ticker called VEA.
VEA. Okay. Yeah. Vanguard Group Inc. FTSE Developed Markets ETF.
Yep, that's it.
Okay.
And
That's
I
like
would put
the UK. Sorry to interrupt.
Yeah. Oh, yeah. No, that's totally fine. So that's, Europe, UK, Japan, Australia, Canada. Yeah.
Cool.
Those were. So I would put a little over, trying to get to 5,000, 1225 in there.
Okay. 1225.
And just while you're doing that, Caitlin, is your job as a wealth manager effectively every day to have these types of conversations with your clients and then effectively make up their portfolios based on your personal knowledge of these different baskets? Or are you working like, how, is that your job? or, or does a
What do you
computer?
do?
Yeah,
What do you do?
you're doing great. So like, is this
This
what
is so
you?
useful.
Yeah, this is so helpful. But like, do you like put it into a computer and they spit them out, or like this is you really being like based on what you said? I think these fit your
Yeah,
interest.
it's super nuanced. So, if you like, as Caitlin provided me, if you provided me sort of a description of who you are and what you're solving for and what your time frame is, you can basically put together a portfolio that sits on what we would call that like efficient frontier of what you're solving for from a long-term return perspective with as little risk as possible to likely get there. I wish it were that easy. The problem is that humans are not efficient. We don't sit on the efficient frontier. We have lived experiences and certain biases. And so my job is kind of like combining the exercise that we're doing, and we use different structures. So we may not always be investing in ETFs. Like we may have some portfolios of a lot of individual stocks or a lot of individual bonds. So it's not necessarily just this, but I think this is a really good implementation for someone getting started. And so you combine that efficient portfolio with behavioral biases. And then for clients who are like, I want to stay away from this industry or
Right.
this particular company founder who seems to have a lot of companies out there, or I really want to express my views in this way, that's another layer. So it's really a conversation and a layering effect.
Yeah.
Yeah, helpful.
Cool. Okay. Now I'm at 3,325 and I've got a little more to go.
Okay. So let's add in some stocks from companies in emerging economies. Think, China, India, Brazil. And so I would look up VWO.
BWO. Vanguard Emerging Markets ETF.
Yeah. I would
I
put
do
like,
love emerging markets.
we love emerging markets. I would put like $175 in there.
Okay.
Just a sprinkle.
Many don't know this. Emerging market stocks are some of the best performing, or is the best performing asset class.
We
this
love to
year.
hear it.
Yeah.
We love to hear it because
And-
Lundie and I just spent 10 years working in emerging markets.
Yeah.
So,
Yes, exactly. I'm still here in South Africa as we speak. So we're always pushing for the EMs.
Okay, so VWO, you said $100?
Like 175.
175. Cool. Great. And how come everything's Vanguard?
Because I'm giving you very low cost, low expense ratio examples. It
So
could be Fidelity, it could be others. This is just for ease. I have no way touting any institution over the other.
And what does that mean, low cost ratio? Does Vanguard charge me for for having made this ETF?
They charge you for investing in the ETF. That's how
Okay.
they continue to manage it and rebalance it. And the thing to keep in mind is, in most cases, you won't see that charge as like a line item. It's implied. But if you want to look up what that is in any sort of investment fund literature, it'll be called an expense ratio, and it
Okay.
will be written out on a percentage basis.
Got it.
Interesting.
Okay, cool.
And Caitlin, in terms of the user experience, did you have to upload or deposit $5,000 into your Wealthsimple account to then go be able to purchase these? Okay, so there's a
had
couple
to-
steps before you can actually press purchase.
Yeah, so from I bank with RBC, Royal Bank of Canada, and so from my RBC account, I sent $5,000 to my Wealthsimple wallet, and then I'm using that $5,000 that's funded into my wallet to purchase these stocks
Okay.
or
Understood.
shares. Sorry,
Probably
shares.
simple. If I in the US made a Fidelity account, I would
Yes.
send money from Chase to Fidelity and then, okay, understood.
Okay, so now 175, and that is emerging markets, which we are so happy about. Okay.
And the final 1,500 or so is going to
Yeah.
be in bonds. And so
Cool.
for a U.S. investor with a U.S. tax profile, I'd recommend a combination of bonds that are invested in a tax efficient way. And in the U.S., that tends to be the most tax efficient way to invest in bonds is through municipal bonds, which are basically the borrowing of local municipalities. I don't know that nuance in
That's fine.
Canada. That's fine. Yeah.
So what I'll do is I'll leave the last 1,500. I'll do my own research on what that looks like
Perfect.
in Canada, and
Perfect.
then in our debrief, Lundie. So at the end of each of these episodes, Lundie and I come back a few days later and do a debrief and talk about the stuff we had to research after just like a refresher. What did we understand? What do we not? What do we need to research more? So I will come back about the Canadian one in bonds in the debrief. Yeah.
Perfect.
Okay, great. That was when someone is guiding you through this, which is probably the point of having a wealth advisor. It is so much easier when someone says like this is what you should look for. But I think having you explain US stocks versus developed markets versus emerging markets and having that diversification makes total sense to me. And I am so happy that I know these tickers, which are what you search in your search bar.
There you
And
go.
again, they are illustrative.
Yeah.
You know, that you could
Disclaimers.
implement this in many different ways. All the
Totally.
disclaimers. All the
Totally.
disclaimers. Yeah.
Yeah. What I will do is in a few months' time or in a year, whatever, however long we want to do this, Lundie, we'll talk about what happened to that portfolio. And,
Performance.
and
Yeah,
then
exactly.
say,
In 25 years, because that was your time horizon. So
in
yeah.
25 years, how
Yeah.
is my 5K
Yeah,
doing?
we'll have
coming back
a
at 55.
anniversary episode.
Exactly.
Truly.
Exactly. Okay, this was super helpful.
Yeah.
What do I do so I've done this, I've done my 5K, Thanksgiving is coming up. And I'm at Thanksgiving dinner, and my sister's boyfriend works in finance, and he says, Caitlin, a recession is coming, sell everything, put it into cash. Do I listen to said boyfriend that works in finance?
I'm just envisioning like Doc Brown from Back to the Future.
Exactly. Yeah.
I mean, I would go back to a few things we talked about. I mean, first and foremost, I would anchor around what this portfolio is for you. You said that this is extra money after doing sort of a lot of the rungs of the ladder that we talked about that you likely don't need to touch, and there's 25-year money. So if that is the case, why would you be selling out of that portfolio right now? I also kind of, again, want to differentiate when we talk about a recession. A recession is a broad decline in economic activity in a place. So that could be a decline in the economic output of a place. That's often referenced as gross domestic product, GDP. It could be people losing jobs, that type of thing. And as we talked about before, The economy is not necessarily the stock market. Markets often fall before a recession starts. They often uh, rebound before a recession ends. So if you're kind of like following along with, whoever, what's his face, um,
Correct.
you're it's
Which one?
gonna
What's his face?
that approach may backfire on you. A
Totally.
few other things to keep in mind, at least for the U.S., we've been in, again, from an economy perspective, expansionary mode for the vast majority of our years since World War II. I think it's something like 80 to 90% of the time we've been in expansionary mode. And then when we do have economic contractions, they tend to be pretty like truncated in nature a year. And I would add that like markets move so fast right now. And there's been so much democratization of investing, for better or worse, that like you have this almost like additional backstop today in retail investors. So it just feels like cycles are so much faster.
Okay.
Well, and to your point earlier, women are potentially better at just letting things play out. And as the saying goes, set it and forget it. So that's why it's there for that particular portfolio. That's what you're meant to do. So it's like, don't freak out with these like micro movements. We know it's going to rise and fall. So you got to just let it ride.
Let it ride.
That's
Yeah.
my
We
professional
do.
investment advice.
Oh, agreed. When, things do get dicey, we're kind of far more likely to stay the course because we like had very explicitly outlined like what we're solving for, and we're just less likely to trade away our gains like our male counterparts.
Yeah. Okay. So in that case, Thanksgiving dinner, I've already made the decision that this is a long haul investment. So don't freak out about the crazes that are coming. Stick to your guns. Hold on to it. Don't sell if someone says there's a recession. Sell all your investments. Okay. Next one is I'm on TikTok or on Instagram and someone says, oh my gosh, this company is going to blow up and be so successful. Everyone needs to buy into it now. What should I do? Should I listen to the TikTok person? Should I buy into the individual stock?
So it's everybody's talking about the TikTokers. Like the TikTokers have existed in different forms for centuries. If you read about like the 1700s, 1800s, like whaling time. I'm always intrigued by like the US whaling economy. There were people who would like spread rumors about different whaling expeditions and like coffee houses.
Funny.
Obviously, there's a history of pamphlets and pamphleteering. And then like if we even think about more recent time, we have these TV personalities, whether it's a Jim Cramer and Susie Orman. So this has existed for a long time. The TikTok piece is its new form. I actually think TikTok, and I'm embarrassed to say I watch a lot of these on Instagram after they've been out in the ether for
We're not on TikTok either.
however long, but it's making the conversation very approachable.
Totally.
Where I would just caveat, kind of similar to our conversation around investing the 5,000, is it completely disregard who the end consumer is. So to say an investment I'm pursuing or making is something you should pursue or make is saying that like, my workout routine should be the same as your workout routine, Caitlin. And so that's what I hesitate around, but I don't think that this sort of way of transmitting economic opportunities is new. It's just like a different form.
Okay. And then going into this, we were so lucky to have you guide us through it. What mistakes do you see women make going into this that they should avoid if they're starting out?
Honestly, that inertia piece and, being energized to do something and then having life come at you again, whether it's job, whether it's care, like all of the other things we're focused on, it's not seeing intention through. That's kind of the biggest mistake. It's not prioritizing oneself.
Okay. Okay. That's clear. And then we're talking about all the trends of TikTok and the whalers that are happening over time. But one thing that is new right now is AI. And a lot of people are talking about AI investment and how it can help you invest. Do you think that AI as a tool could help more women with investing?
I think AI can help everyone. I was reminded by AI this past weekend. I'm something called a CFA charter holder. And for those who don't know, the Chartered Financial Analyst Program, it's effectively like a financial boot camp that you can subject yourself to after university. It takes, years of study. It's codified by 3 like brutal exams. The guidance is to spend 300 plus hours studying for each of those 3 exams. So nearly 1,000 hours of studying. And at least when I took the CFA exam, each exam had a pass rate of like 35 to 50%.
Wow.
And there weren't dummies taking the exam. Like some of the most talented people I knew took the exam and didn't pass it. So what was most striking for me to learn this past week is several AI models have taken all 3 levels of the CFA exam and passed them within minutes.
Wow. Wow.
And it's an interesting reminder that the landscape has changed and will continue to change. And so, like, for me, value add is not how I scored on those exams or investment jargon or whatnot, but it's showing up to clients with empathy and clarity and nuance. And I think that's what clients will continue to expect.
Okay, my last question for you is, what is one thing you wish every woman knew about personal investing?
I think, and we touched on this, I think the hardest thing for women is thinking about where to start. And so if I were, we talked about a lot of areas to start, but if I were to say, okay, go back and think about these things, personal finance really has a few main core components, and that's what you have, it's what you earn, and what you spend. So if you want to start investing, begin by knowing your balance sheet. So that's your assets, your liabilities, also know your income and know your spending. And in its simplest form, and we talked about all the nuances around this, but like your investment capacity is your earnings or what's coming in less than your spending. So when I have these conversations, a lot of times I'll ask, like, when was the last time you looked at your prior year's tax return? Or when was the last time you actually had an understanding of your spending and what you're spending your money on? And those are exercises that I realize are like the worst and no fun, but you really need to start there, because all of the rest of the stuff is just kind of like unknown if you don't have a sense of what's going on in your life.
That's great
That's great
advice.
advice. Yeah, got to start even before you start. You got to start.
Totally.
Great advice. Yeah.
Amazing. Well, Cam, thank you so much. This was amazing. I'm excited to do my research on my Canadian bonds. Watch this space, coming in hot. But it honestly has been so helpful. So we can't thank you enough.
Thank you, Caitlin. Thank you, Lundie. I look forward to the 25-year reunion.
Yeah,
Exactly.
exactly. See you in 2020, 30,
2050. 2050.
2050.
Crazy.
He's like 2030.
2030.
London's not doing
math.
investing.
This is why I am not a wealth advisor. I am not the actual expert. Quick math. Thank you so much, Kim. This has been so great.
Amazing. Thank you both.
Welcome to the Debrief, where we discuss things we needed a little more clarity on.
Yes. Happy Friday.
It's been a week. Friday to us.
Investing. Our favorite
Cameron.
topic with Cameron.
I know.
I almost want to hear how your portfolio is doing 2 weeks. ago.
Okay. Well, this is a month in. I just checked. Just looked this up for a second.
It is November 7th for anyone listening, and
We recorded it October 1st.
seriously?
I know. Yes.
Guys, this
It's been
year,
over a month.
has just, and like by next weekend, it's pretty much like we're mid-November. I'm like, I can't keep
Yeah.
up. I can't keep up.
No, I know. It's
But
slipping by. It's
want to hear how your portfolio is doing.
okay. So, what I had to do, so I wasn't able to put everything through on the call. I had to do it after because I realized what I needed to do is I open up a separate wallet in my robo-advisor app that was dedicated to this investment so we could properly track it. So I ended up buying it, I think, like 2 days later, just to be clear on the timeline. And then I also had to do my research into bonds because 30% of
Canadian bonds.
it was meant to be in bonds. But then, ding, 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 I was using US dollars because I had US dollars in my savings account. And so then I Googled it, should I be buying Canadian bonds with US dollars? And it said, no, you should not be buying Canadian bonds with US dollars. So then I asked ChatGPT, I don't know if it's a good investing advisor, probably not. But I said, okay, here's what I was suggested. I'm a Canadian but I'm using US dollars. What should I buy? And it gave me some options. So I don't think it's very interesting for me to go through all of those options. But I did spend 30K, or sorry, not 30K, 3K. What am I doing? 30% of the portfolio went into bonds.
Went into
And
bonds as not
I
told
do-
to by an actual expert. So we
Exactly,
did not
exactly.
give our own advice.
But I do think what is important to know is when we were going through, she was saying like, okay, now put $1,400 into this, put $700 into this. The way it works is you can't like put an exact amount of money in. You're buying kind of shares into this ETF because the shares are worth a specific amount. When you put in $700, it doesn't come out to exactly 700. It'll be like 703 or like 1407. So it was like a little bit off to the percentages she gave me, but it's up 0.14% in 1 month.
Cha-ching, cha-ching.
Thank you, Cam. I've made $9.
Fantastic. Well, you know what? It's $9 more
Yeah.
than you had a month ago.
Exactly.
We
Yep.
love.
I'm going to go spend it all. No,
Okay,
just
well,
joking. This is my $25 one.
No,
Or
you-
25 years. 25 years. That was a rogue. I really made that up on the spot. I don't know why I said that.
I
25
know you were
years.
like,
I probably
I
am going
don't need to see this money for so long. I was like, all right, well, good on you.
It was so rogue. I think I was saying what I thought I should say, but realistically, I'm probably going to use this money before that. So I don't know if I need to change it for what I need it for, but
Yeah,
that's
a
okay.
little less risky. Okay, amazing. Well, any key takeaways?
Yes. Okay. So, first one for me was stocks versus bonds, which we just briefly spoke about. I think she explained it really well by saying stock is ownership, you're buying a piece of something, and a bond is lending. You're lending money to something and you're going to earn interest back on it.
Never
I think
knew
that's
that.
a really, there we go. I think that's a really easy, quick way to know stock versus bond. Stock, ownership, bond, lending.
Totally.
And then on the ownership, you can earn money through dividends. I think that's really a quick and easy way to know that. And then my other one was when to start investing. And I think this one is super key because I feel like, and I said this to Cameron, that we're told like, you just need $1 to start investing. And it's true. You do need $1 to start investing because you can't invest without it. But there's so much you should think about before you start. So paying off high interest debt, having your emergency fund ready, all of it kind of tapped out before you then start investing.
Exactly.
And I did look up, because we spoke about it, credit card debt, and because we were speaking about high interest debt. And the average credit card interest rate is 21% in the US.
Oh my
So
God,
if
I thought you were going to
you-
say like 11, which is still incredibly high. Wow.
No. Yeah.
Wow.
Yeah. So you should be paying off your credit card debt before you start investing, because it would be a very good day in the market if you earned more than 21%.
Got it. Yeah, that makes total sense. I mean, that was one of my key ones that I wrote down, which is there are so many steps before. Like, I feel like we do ourselves almost a disservice. Yes, we should all be investing in the best case scenario and in a perfect world, but like there are so many things that people have to consider before that becomes an option. And so
Yeah.
I think that's just like an important thing to keep in mind, because you almost get down on yourself for being like, I'm not and it's like, there's lots of things you have to like think about before that. And it's hard to have
Totally.
6 months of savings in an emergency fund, and it's hard to pay off your debt, and it's hard to
Totally.
have a retirement fund set up before you even open a brokerage account. Like, it's a lot. So I
It's so
think,
much.
yeah, it's a good takeaway that it's like, there's a lot of steps, and it's hard to do, unfortunately.
There's budgeting. Yeah, I guess it is. It comes down to probably budgeting.
Yeah.
Which who knows how to do that either.
Well, I wrote down, she said, know your personal balance sheet. What's a balance sheet? Who's to say? But she said basically it's a list of what you have, what you earn, and then what you spend. So it's what you have plus what you earn minus what you spend. And so I think just having a baseline understanding of your personal finances is like a step to take long before you even consider investing.
Totally.
And just like work towards it, slowly, but it's not an easy thing to do. Was one of your key takeaways that you should have an emergency fund in cash and not
in cash? Exactly. Not invested. I was like, ew.
You're like, what if
Which is
then I just cash out? And she's like, no, don't do that.
no.
You never know if you need to have cash on hand and you don't want to cash
true.
out of a market if it's in a dip or whatever.
Yeah.
Another one of my key takeaways was that it's really hard to explain. Like, in listening to this episode back, and please, anyone who is listening to this, let us know what you thought and what questions are still there for you, because there was a lot that I was still confused about. And I think that's why nobody's really cracked the education. Nobody's really cracked the education space around this, because it's hard to understand. And that's
Hard to
another thing
understand, and it's not fun.
Yes.
And a little stressful.
Totally. And Cameron's amazing, but it's not the most fun thing to listen to. I can admit that. We produced it.
Totally.
So
Totally.
if you are still here,
Yes.
thank you for sticking with us, and send in your questions, and like hopefully you learned something. Everything is better than nothing, but it's a hard one. It's dense.
Yeah. I was chatting to Steven about it when I was listening back to the episode, and we were talking about how just like the stereotype is that guys are more interested in investing than women are. And I said it's because women have so much going on, and it's just one more thing we have to think about. But he did, and we were chatting about this, make a good point that it's been really gamified for guys. Like it's like, oh, who can do the best on the markets, who can do whatever, which does result in losses, which is why women end up being better investors.
Yeah.
But I think because it's gamified, it gets more women in the door, or sorry, more men in the door, in like, oh, I want to be in on this game. So I don't know. It's just food for thought for women.
People who look like you, talk like you, who you can relate to, who are doing well in anything. It's like anything you want people to like aspire to, and that's something that Cameron said. She was like, there's the boys club where they invest amongst each other, they celebrate their wins, their successes all over the show, and not have that quite as much. And it's changing slowly, and that's why we're doing what we're doing, is to amplify more of that. But it's a slow burn. It's a slow burn. It's a slow trickle. I was looking.
So,
it is
honestly, happy. It's Friday.
Crawl. Slow crawl to the end. Thanks, everybody, and see you next week.
Literally, see you next week. Is that all? That's all our takeaways?
My takeaways were, it's harder than it sounds, and it sounds not that fun. Those are my two takeaways.
Yes. I know it's fair. But you know what? Unfortunately, we just got to do it. And that's
just got to do
the reality of it.
Take a small step today towards doing one of those things on the list, whether that's paying off debt, or setting up a retirement fund, or paying off your credit card, or setting up a little savings account for a rainy day. All of those are steps toward investing, even if you're not investing today.
Exactly. Because knowledge is power. Let's fucking go.
See you next week.
See you next week, ladies.
Tune in next Tuesday to find out why sex drive is a myth, why your libido is totally normal, and how to have spicy and pleasurable sex. We're asking, what the fuck is libido, to Hannah, the libido fairy.